What is happening to furnished holiday lettings from April 2025? Hi, I'm Kimberly Shapcott, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. We have known for a short while that furnished holiday lettings are going to be changing, and there's some quite significant changes afoot going into the 2025-26 onwards tax returns that you are going to be doing for any properties in your own name. So what we are going to do today is going to have a look at some numbers to see how that change is going to affect you, as we are now going to be impacted by Section 24. So let's have a look at an example, and then we can show what is happening with the numbers to show you how you're going to be taxed for income tax, what happens with some of the losses, and also what about the capital gains tax. This is going to be best described using some examples. So let's dive into the examples and we can see how it is all going to fit together for you going forward. Let's dive into our example, which is going to show us what the impact of Section 24 is on our furnished holiday lets or serviced accommodation. So I'm going to give us two examples, which gives us a basic rate taxpayer and a high rate taxpayer, and just a bit of a comparison as well to see how that fits together. So for my example today, we are going to have a salary of 30,000 as they're doing it part-time. They're going to have income for their SA business of 25,000. We're also going to have some mortgage interest, because that is the key change that we need to be aware of. And we have got our expenses for our SA businesses that are allowable. So we're going to put 10,000. So now we can look at calculating what is going to be our tax. So we'll do a before and we'll do an after. So we'll start with our after, so you can see, and we'll put our before over here. Now our starting point is we've got salary, so we are going to have income of 30,000 in both sides of our calculation. That is not going to change. We've also now got our serviced accommodation income, or profits let's call it, and this is where things have changed. So before the changes, we would take off our mortgage interest, we'd take off our serviced accommodation expenses, which would in effect give us serviced accommodation income of 10,000, which would give us a total income of 40,000. Whereas now we can only actually take off our serviced accommodation expenses, and the mortgage interest is now no longer allowable at this stage of our calculation, which means our income has suddenly gone from 40,000 up to 45,000. But we do have finance costs of 5,000, which will be brought back into the calculation shortly. So let's have a look at how our tax is calculated. Now we know we've got our personal allowance, which is our 12,570, and that is the same case before and that is the case now. We then have some of this income taxed at 20%, which, because we're in the basic rate, will be the rest of the income at 20%, which will equal 6,480. Then we'll also have 20% at 27,430, which will give us tax of 5,486. So now our total tax here we can see is 6,486, and our total tax here is 5,486. Now for our before calculation, that would be us done for calculating, and we'll come on to the rest of it in a moment. For our after calculation though, we now have to look at our finance costs, which is our residential finance charges. Now for this, we now have to look at three things. We need to look at the lower of our finance costs, which is 5,000, our property profits, which is 15,000, or our adjusted total profits, which is 45,000. So on this basis, we've got 5,000, which is the lowest, that we can get a 20% tax reduction on, which gives us 1,000 that we can take off. So our actual total tax payable is going to be 5,486. Now, we have paid tax in our job of 3,486. So that means to pay, we actually have 2,000. And again, before, we also did pay our tax in our job of 3,486. So tax to pay would be 2,000. So the key issues we have to worry about here is that our income is higher, which means that you will be reaching the higher rates of tax at an earlier stage than you were before if you have mortgage interest. But in effect, the amount of tax to pay is actually the same generally for a basic rate taxpayer. The general issue starts to arise where you've actually go into the higher rates of tax. And let's look at an example where we're in the higher rates of tax. So let's put in a salary here of 65,000, which definitively gets us into the higher rates of tax. We've got our SA income of 30,000 for this example. We've got some interest on our mortgage of 7,500, and we've got our SA expenses, which are coming in at 12,500 for this person. So if we start with an after and we have our before over here, we can see how this comes together. So again, we'll have our salary, which will be 65,000 on both sides. And then we can look at our SA profits. And our SA profits are going to be, before, they would have been 30,000, take away 12,500 and the 7,500. So we'd have actually been taking off 20,000 to give us profits of only 10,000. Whereas now we actually only take off our 12,500, which actually gives us profits of 17,500, which is obviously much higher than before. Now this is all the income we're including on this example. So that gives us here total income of 82,500 compared to 75,000 before. So that's quite a noticeable increase, although we do have finance costs that will kick back in on our current new method of doing things. So let's have a look at the impact on tax. So again, we still have our personal allowance because we've not hit the over 100,000. So we've got our 12,570 at no tax. We then get charged at 20% for the next 37,700, which gives us a figure of 7,540. And that is the case for both. We are then now moving into our 40%, which the rest of it, 40%, will be at 32,230, which will give us 12,892 tax to pay in our after. And before, we would have been paying only 24,730 at 40%, which gives us 9,892. So let me just total those up. So as we can already see, the tax charge is noticeably higher. But we're not quite done with our after one because we still have our finance costs. And this, as we said last time, is the lower of finance costs, which is our 7.5, our property profits, which on this occasion is 17,500, or our adjusted total profits or income, which is 82.5. So on this time, the lower is 7.5. So we are 7.5 times 20%, because we can only get a 20% tax credit, which means we're going to be taking off 1,500. So our tax at the end of the day is going to be 18,932 that we can be paying. Now we will have tax paid because we've got a salary here, so we will have paid some in our job. Same here for tax paid before, which is 13,332, which gives us tax to actually pay of 4,000 before, compared to tax now to pay of 5,500. So we've got an increase of 1,500 tax to pay when we're at the higher rate of tax. And this is generally because we're only getting the 20% tax credit, whereas before we will have been getting the 40% tax relief, because we will only been paying tax on the profits, not on the profits excluding the mortgage interest. So it's something you need to probably have a look at for the new tax year, see how it may or may not impact you, whether you'll be pushed into the higher rates of tax or not, to see how much of an impact this is going to have on you. If you're remaining as a basic rate taxpayer, then the impact is going to be relatively limited. However, if you are getting close to the higher rates of tax, with the change in how it's calculated, it may push you over into the higher rates of tax, as we obviously had up here, that higher amount of income on the basis of not being able to take out our mortgage interest as an expense against the self-serviced accommodation profits. From a capital gains tax point of view, we need to be aware that things are changing and some of the reliefs available are not going to be available anymore. Check out the separate video on capital gains tax for serviced accommodation if you are looking at selling your business, on how it will be going forward, so that you can just take that into account as you come to do the calculations of selling potentially your business, or whether you go down the route of just selling the property. Our capital gains tax rates as of 2025 are at 18% and 24%, and that is the rates that we'll be working with going forward for now. As you can see, there is a few changes afoot, and it is going to tweak things on your income tax return, and also if you are going to be selling your business, then you need to just be aware of some of these changes so you can put appropriate plans in place as you work through the different areas. Hopefully today you've discovered exactly what is happening with furnished holiday lets, and you can see how the calculations will work for you going forward. If you have any questions, then please do leave a comment. Please like the video and do subscribe to the channel. And let's make tax less taxing.